Entrepreneurs Podcast.
Welcome to the Real Estate Entrepreneurs Podcast. Today we have Mr. Randy Langerderfer. Is that okay? Is that right, Randy?
Pretty close, Ricardo. Langerderfer. But Randy is fine.
Where's that last name from?
German.
All right. So you're German heritage, I suppose.
Yes, sir. My father was full blood.
And you're here in Houston, in the city of Missouri City. You said, right? Houston whereabouts? Like me. I'm surprised. Like we were talking off camera that we never ran across each other. I've been in Houston since 2005. So
wow.
I don't do apartments. So maybe that's the reason, right?
Yeah, that's probably so then.
But tell me about you, man. Like, where do you come from? Like, where are you from? Houston? Are you from, where are you from originally?
Hey, Ricardo. Well, first, thanks for letting me be in your show. Great opportunity. Glad I'm here. I just appreciate it again. But I do live in Missouri City, Sugarland area of Houston. For those that are familiar with it, in the southwest corner. To answer your question, I'm from the great state of Ohio.
All right.
If you like football, you know I have to give all my Texas friends here
a
hard time about this last weekend, as this is being recorded last Saturday night. The Buckeyes beat the University of Texas, but came to Texas 2013, so almost 13 years ago. I was working for a private equity company in the Cleveland metro market of Ohio, and I realized that job was winding down, and those jobs aren't meant to last forever. So I really started to seek another income source. I was realizing I just needed to find another income source. So I looked at, franchises, various small business, buying a small business, getting a real estate license, et cetera. Long and the short of it is I got a brother-in-law who I really respected a lot, a banker. Got me involved in flipping houses in South Florida. So we lived in Ohio and we're flipping houses in South Florida. We were hard money lenders, very simply.
Right.
And I learned about multifamily a little bit when I came to Houston in 2013. I attended a lifestyle conference, and then I went to Brad Sumrock for 3 years. I've been in Rod Khleif's program for about 2 years. I did my first passive investment in multifamily in 2014. A lot of great stories there. I did my first general partnership where we put the deal together in 2018. Fast forward to today, I'm in about 1,000 different doors, 5 or 6 different properties from Tucson, Arizona, Houston, Dallas, Greenville, South Carolina, Kansas City, Missouri. And so I set about this course 10 years ago to really build into multifamily so that I could leave corporate America. Happy to say summer of 2023, 2 years ago, I separated from the corporate world, and I've been doing this since, and I'm having fun doing what I want to do.
Good deal. So, so you were more of a passive investor, or
I started out as a passive investor to learn the trade, and I didn't want to ask other people for their money. So passive investing seemed right for me, and I made some really good returns. And once that happens, you get a little greedy and you want more. So I got into the general partnership where I was finding deals and putting them together and finding investors to buy them, et cetera, et cetera.
Let's go back. Let's go back to your previous life, the life of private equity world. I love that because I was in the oil and gas business, and this is something I never said before on a podcast or to a lot of people. Only a few know about this. But in 2013, roughly, I was running a product line for one of the larger service companies here in the Houston area. I was already a real estate investor, but I was kind of like you. I was doing it on the side. I wasn't paying bills with it. It was more for wealth building and that kind of stuff. And I noticed that the company I used to work for, I'm not going to mention any names, they were going through some, I would say, it's cash flow issues. And And I said, man, I wonder if I can buy this product line, because this is no different than buying um, a house from a motivated seller,
Sure.
or an apartment complex or whatnot. There's a P&L, and my numbers were very strong. We had a business that was producing about $130 million a year, and
Real money.
our profitability was about 38%. So it was net, so it was a very lean business. It was good. It had some cons, which some of our bigger clients were oil companies that were state owned, so they could change the rules of the game at any given time. And anyhow, man, I went, and the real estate investor got in me, and I said, you know what, I'm gonna go put something together. So I found a company that I could buy and pair with this product line to make it a stronger offer for a private equity group, which is what you did.
Yeah.
So I started going to doing the what we call it, the dog and pony show, and
Mhm.
we started going around, and I would start showing, hey, this is my product line, this is the company that we want to buy. And by the way, the owner of this company will be the CEO of the company. I will be the COO, because most of what I did was operations, right? And
Okay.
sales. So, and I didn't know how to be a CEO, to be honest with you. I never had conversations with private equity groups or anything like that. This is the first time I'm doing this. And in a period of 6 months, I went and visited probably 6 or 7 private equity groups, and they all loved the business. But for the most part, I was either our packaging was either too big for them or too small for them.
Right.
There was not one that was within our range. Well, finally, we found one, and we got a commitment letter of $300 million to buy this business from the service company. And the service company, we had knocked on the door already, and they were interested because they were going through tough times. But that's when I said corruption got in between, and then they shut that down. And next thing you know, they're not selling anymore, and I'm getting fired. So um,
They shut the whole business down.
they didn't shut the business down. They shut the door open for us to buy it,
Oh,
and then they fired me. And so I went and found $300 million for these people, and. And the craziest thing is, 5 years later, they're calling me to see if I still wanted to do it, and I was no longer involved in the oil field anymore, and that business wasn't worth it. But I think that was gonna be the deal of my life, to be honest with you, because I never done something that big, and it was an amazing business. But anyhow, that's how I
wow.
raised $300 million to buy a couple of businesses, put them together, and create a new company. Now, based on that, like, what was your primary focus in private equity?
Well, I was an administrative guy, so I worked for it was a company, a spinoff of Goodyear Tire and Rubber Company. It was, think of it as all the non-tire stuff that Goodyear manufactured: rubber hoses, rubber belts, everything for engines to the mining companies, large industrial conveyor belts that would run for miles. Operations all over the world. They were about a $2.5 billion company, and for all the reasons that we've seen today. Goodyear wanted cash, so they spun that off to raise cash, and Carlyle bought it, and it was just. And to your point, you've seen one. Every private equity company is different.
Yeah.
I'm told there are more private equity companies than there are listings on the S&P 500. That there's so many private equities, from micro to the KKRs, the Blackstones, the
Yeah.
Carlyles are the three behemoths that I can think of, and they just invest in everything. I mean, they've got housing portfolios, and they got every kind of thing you could imagine. But then there's the mid-range ones and the small ones. I worked with a guy, the very small one, when I was in Cleveland, that was buying a medical equipment company, and he was buying $1 and $3 million companies. So they're just everywhere. But it's a fascinating education when you get inside of the mind of a private equity guy, because it's all about the numbers. And I mean, They don't care what the story is. It's about the numbers and how do you increase EBITDA.
Right.
Period.
Can you I
Because it's
love
all
that
about
you
cash flow.
mentioned EBITDA because a lot of investors, especially the ones that are coming from hustling, right? From because the thing about real estate investing is there's no entry barrier. Like anybody
Right.
can do it, right? As long as you get the proper education or you get in the right rooms, um, you can do it. Like you can be a wholesaler, you can be a flipper, a fix and flipper. If you have some money, maybe you can get into lending. But what is EBITDA? Can you explain that to us?
Yeah. So EBITDA just simply stands for is the earnings before income taxes and depreciation. So it is the true measure of cash flow, how much cash a business, be it real estate or anything else, is generating. In the multifamily world, we look at net operating
Yep.
income, but that's really different than EBITDA. That's up higher. So think of just EBITDA as it's the pure cash. After you paid debt, after you paid all the expenses, what's left? Excluding interest expense, I'm sorry, and depreciation, because those are uh, generally excluded from a cash flow perspective. But that's very simply what it is, and it's focused on how much cash does the business generate, and it's any business, whether it's a car wash or a large multinational firm. So, and that's what private equity firms are basing their acquisitions and their divestiture strategies off of. They're looking at they want a multiple of EBITDA, 2, 3, 5, 10 times EBITDA to sell a company, or they want to buy them on the cheap at, as you said, when the cash flow is hurting, they're going to buy them at 1 or 2 of EBITDA, or maybe 3 at a steal, and grow the business, hopefully increase the EBITDA, and then sell it for a multiple of that to somebody else.
Yeah, I think at that point our offer was something. It was based more on the revenue and the assets as well than the cash flow itself, right? So cash flow was
Yeah.
amazing on that business, but it had a lot of assets and we
Even
yeah, it
better.
was even better, right? So we were making an offer of 300 million for a product line that the revenue roughly was 120 million a year, um, with a net profit of roughly 38% of that. So whatever that is, I don't know, 40, 50 million. We were paying good money because we knew we could do better with it, and they had a lot of underutilized assets. So that was our plan, was to like grab those underutilized assets, move them from locations, send them to other countries and make more money that way, as well as put new technology coming in for different services, right?
Yep.
No different than real estate, which is what a lot of people have a
No.
misconception that they're in the corporate world like you were, and they look at real estate like, oh man, this is, I don't know, real estate contractors. I don't know if the price is going up or down. Now, in your opinion, Randy, what makes a savvy multifamily operator?
Wow. One I've never been asked. What makes a savvy multifamily operator? Um, One, I think that is, I would say a good operator is one that's based upon the numbers. They have a sound financial. But like any business, I don't care whether in the oil services or you're in multifamily, single family, or retail, it's about operations. Who's running the business? Somebody, you had expertise in that line
Right.
of business that somebody else didn't. I've got expertise in multifamily today that somebody else may not. Yes, you can learn those skills, but it's much easier to just buy them or partner with somebody to get into those skills. So,
Well, I don't know what happened, but he cut off. um are you there, Randy? Well, I'm going to see what happened. Anyhow, whoever's watching here, please put in the comments, hey, Ricardo, what's up? Here I am. I'm watching the show. I don't know if you're watching on YouTube, on Facebook, Instagram, LinkedIn, you name it. So what I think I'm going to do is I'm going to announce that we're doing an event in Charlotte, North Carolina, November 7th, 8th, and 9th. And this is going to be big. It's a business event. We're going to have multiple industries coming in, and it's going to be pretty good. So hit me up for details. You can find all the information at attendgrowth.com. Let's see if I got here. Yeah. 10growth.com. There you go. 10 Growths, November 7th, 8th, and 9th in Charlotte, North Carolina. So we're going to be doing a real estate event over there. Hopefully you can join us. If you're watching from that area, if you want to fly in or whatnot. What's up, Randy? You're back. Also, don't forget to hit share, like, and subscribe on our podcast, the Real Estate Entrepreneurs Podcast. Randy's working through his technical difficulties there.
Technical issues. Can you hear me?
I can hear you, but I don't know what happened.
Yeah, it was on my end. I apologize. If you can hear me, that's great. I'm working.
It's okay. Take your time, brother. No rush.
There we are. Can you hear me now?
I can hear you, but I cannot see you.
Yeah, that's coming next here.
All right, perfect.
Okay.
So
how about that? How about that?
Oh, there you are. Good.
My apologies, man. My apologies.
No, you're good, man. Hey, it almost happens in every podcast when we do them live, So it's all good, man. No stress. We can always edit this out, take it out or whatever. No big deal.
You asked me what makes a savvy
multifamily operator.
And so I said, I think it's one that's got at least twofold. Primarily, it's always based upon the operation. Somebody's got to have operational expertise. Somebody's got to know how to run the business. Like I said, you in the oil services, me in multifamily. It's got to have based upon numbers. And so when I talk to people, I try to help them educate and learn how you evaluate a good deal from a bad deal in multifamily, or even in single families. Everybody's going to tell you it's a great deal. Everybody's going to tell you this is a great deal. My deal is a great deal, but it's up to the investor to determine if it is or it isn't, and if it meets their investment criteria. Because I may want a yield, you may want appreciation, and anything in between. You may want a 10-year deal. I want a 2-year deal. So it's really important. Investors need to be aware, as you said. First of all, people like to invest with those they know, like, and trust.
Yeah,
that's first most. And then second thing, you got to understand the deal. Where is it at? Why in that location? What are the underwriting assumptions? What is the growth assumptions? Multifamily has been hit really hard in the last couple of years, as you know.
Yes.
And nobody expected that.
Well, everything is being getting hard in the last couple of years. Even single family, because with the interest rates the way they are, the affordability has just dropped significantly. So, right. If I'm a buyer of a single family home, like I'm looking for a house, I was looking for a property to buy, and I went into my own neighborhood. So houses in my old neighborhood are somewhere in between $800,000 and $1.5 million.
Wow!
But they can rent for $3,000 to $4,000. Why would I buy something that costs me 2 or 3 times the amount of money that I can rent it with? Makes no sense. And that's what's happening in a lot of areas in the country. It's just that the interest rates are keeping the affordability to buy properties low. Same thing is happening with multifamily, where and banks are not renewing loans. Like some of those guys that had some loans that were coming up due, they're in a bind. Can you tell me a little bit about that?
Well, multifamily, I'm struggling through one right now myself. So multifamily, if you bought an asset in 2021 or 22, you bought it on variable rate debt. And nobody, and if you did, you're not listening to this podcast, with all due respect, Ricardo. If anybody predicted that, they're someplace else making tons of money doing something consulting
Right.
wise. Interest rates went up 5.5% in less than 18 months. So the best of underwritings couldn't predict that. We bought properties and we bought what's called rate cap insurance. We bought an insurance. If the interest rate went up 2%, this policy kicked in to pay the increased interest. And that was great, but it only lasts for 3 years and it has to be renewed. And it's phenomenally expensive to renew it compared to where we bought it. So those challenges, the interest rates are very real for the general partners. They're real because they're pushing rents up for the tenants. They're pushing operating costs up for the operator. Employees want more money. It costs more to have services performed on the property. So it is just a real pest for everybody, but
For
hopefully
everybody, yeah, because the operator needs to squeeze money from anywhere to make the NOI look better. That's really what it comes down to when it comes to refinancing, right? Like, hey, how much am I? What's my spread so I can refi?
Totally right. Totally right.
Now,
And there's only so many places you can take it from after debt.
yeah, of course, and then it doesn't always work the way you want it, right? Because you may have tenants leaving or situations that are completely out of your control, and then how do you handle that? But why aren't the lenders, the people that loan money on these properties, not being more flexible? Why do they want to go? And because I've heard of people that they lost the properties basically, right? And these are great operators, good. They had the best intentions in the world. It was never in their mind, to get into a bad deal that they were going to lose in a few years. But it's because these lenders are really not that flexible. Is it that they want the properties back? Is that what it is?
I wish I knew that, but we won't mention the name, but you mentioned one before the show. Is a great operator and lost several properties. And, I know that gentleman well. And like I said, he's done a great job, but wrong time, wrong place. And I wish I could understand the lender's mindset. We have one that is operating very well. We've turned the property around. We've re-tenanted the entire property. It's cash flowing right now. You there still?
Yeah. I'm listening.
I'm sorry. I thought I just saw signs that we got disconnected, but for some reason the lender won't even talk to us. So it becomes very challenging. And the only thing I can think of is the lenders are learning from the real estate crisis in the 80s and stuff, when they didn't take properties back soon enough. And then there was a real hodgepodge. So I don't have the right answer for that one, Ricardo. I wish I knew it more, but they're much more aggressive, much more aggressive.
That's weird. Because if I'm a lender and you've been a good operator, you've been making your payments on time, and everything is being, I want to work with you. I was under the impression that lenders don't ever want the properties back. They just want to loan the money on the properties.
Yeah.
But it seems like that is not the case in the multifamily space, because, like you said, some people have been, and I talked to him, he kind of like explained to me everything. We've known each other for quite a few years. He's actually come to my events and spoke on stage and all that. I do real estate events around the country. And so, I reached out to him one day and I said, hey, man, anything you need from me, let me know. I just don't know how I can help you. I'm not in that space. But, it seems like these lenders in multifamily are a lot more aggressive than the ones in the single family space. And they might not just be lenders. They may be private equity groups that are just loaning money out, and now they see an opportunity to take over an asset that's stabilized, and it's a huge gain for them. That's the only thing I can presume.
I mean, we asked the lender to basically just take a reduction in interest rate for 2 years, so we could ride this out, and hopefully in 2 years we'd turn around, or they could foreclose then and still make money. But they said, well, why would we do that? We can do that ourselves. And I'm like you, I have the same assumption that they didn't want to operate properties. But this lender appears to want to operate. So it's frightening because
and it's devastating because a lot of people's monies are on that deal, and that money just wipes out.
And historically, it's proven that when banks take over properties, they run them into the ground. They're not operators. They'll hire somebody, but it's not like, we're meeting weekly with our asset management team on the ground, our property management team, and trying to make sure that all the business plans are being achieved too. So time will tell how this really works out for the lenders. I predict on this one property that I know of, if it happens, they're gonna lose money. So
okay, so
in the long run,
it is a headache that they're inheriting pretty much, right? So that's how I see it. If I'm a lender, I really don't want that headache to come back to me. That's somebody else's headache. Let them fix it. Now, what are the rates today, or the terms that are preventing operators around the country from refinancing these deals?
Well, every situation is a little bit different, but I've heard the market rate is, last time I took it, it's still in the high fives. When I was pricing my most recent property several months ago, was in the high fives. And so the challenge is seller expectations with the lender debt requirements. Sellers still have a very high expectation that they want to double, triple their money, and I should pay for it as the buyer. Not a good business situation if you're a buyer to start out overpaying for something, unless you got a huge portfolio and you can blend it in. But I think that's one of the biggest ones yet. Seller expectations have not adjusted to the current market conditions, in my humble estimate. Some have. Some are being taken back by the bank, and the bank is trying to negotiate with their preferred borrowers. But I think that's a really big one. And then just the numbers don't work. A lot of these properties are old and have a lot of deferred maintenance on them, requiring millions of dollars of investment in roofs, parking lots, interiors, security measures. Tenants want all the electronic gizmos today, remote entry, remote thermostats and stuff. It's not, I think it's going to start happening, but I don't really think my personal forecast, it's not going to be for another 6 to 12 months before we really see. I think the Fed's going to lower some interest rates here in the fourth quarter, but it's not going to be material enough to really make a difference yet. So
I saw yesterday President Trump, he spoke on national television, and he was talking about that. He wasn't talking about specifically multifamily. He was just talking about reduction in rates and how we needed a little bit of help from the Feds, and that of course he takes it to the whole political side, So, but it's true. I mean, if the Feds don't do something real quick, not only the multifamily, but the commercial and the single family and everything is going to be affected. Today, I have seen more properties going into foreclosure and defaulting than, I don't know, back in 2024, when we were still kind of like riding the wave up a little bit, even though the interest rates were going up. And it's very scary. There are people walking away from properties right now because they just can't afford it. I don't know why they got into that property to begin with. And maybe they lost their job. Something changed in their life, and they can't make those payments anymore. But I think you are right. That bubble is going to burst in the next 6 to 12 months, and it's going to be ugly.
Well, and the other one I want to point out for your listening audience is the difference between multifamily and single family. The beautiful thing about multifamily is even when that happens, I didn't have to sign personally on the loan for my multifamily properties. So it's called a non-recourse loan.
Right.
The bank secures it based upon the property itself versus my primary residence. If I stop paying the bank, they can take my cars, my bank money, et cetera, et cetera. And in non-recourse debt, which multifamily is, that's one of the advantages to do it. That's what got me in it early, is because I can buy multi-million-dollar assets probably easier than I can buy a new house, because I don't have to show proof. I have to show proof of income and everything like that for a house. But I don't. The property secured the bank's debt on a multifamily. So,
yeah, they're basing the loan based on the business itself, right? It's just that the business has a real estate component attached to it, but it's a business loan when you look at it.
that's right.
And it's not personal guaranteed. And then you do it. Are you doing syndications, or how are you doing this for your?
I'm a classic syndicator. Where we'll go out and find an asset, and we'll put down 20, 30, probably 30% of it today in terms of equity through syndication. For your audience, that just means we're going out and talking to friends, family, relatives, and everybody else we can think of that may want to invest in these to raise the 30%. Bank gives 70% of the debt, and we're off and running. And the hope is that I got in 2014. I'll say 2014 through 2021 were banner years. It was rising tide lifted all ships,
Yeah.
because it was just, you didn't have to be real smart to do it, put it that way. And that's what attracted all these syndicators like that don't have even as much experience as I do, that attracted so many newbies to the industry. And a lot of them are the ones that are, so the herd is going to be called here of multifamily properties, because there's just going to be a lot of them that simply go out of business. And even those that survive are going to have a challenge raising capital, because investors are skittish. They're worried about if this, you tell me this is a good property, Randy, but is it really? And I'm trusting you. So make good on your promise. And it's syndication is a great business. I mean, it's not new just to real estate. I mean, the investment houses have been doing it for years. You know about it in oil and gas. They syndicate it in oil and gas all the time. Different companies on operating.
Oil and gas is very high risk. I would much rather put money on a multifamily or an office building or something along those lines than oil and gas. That's just my preference.
A lot of dry holes.
Wells do come dry all the time. That's the problem, right? So what happens when the wells are dry? Money's gone.
Yep. But man, when they hit, do they hit?
Oh yeah, their multiples are insane, right? And that's an industry that will continue to make multimillionaires, for many decades to come. We're not gonna. Everything in the world kind of like runs around oil, like you were talking about Goodyear, and what's their primary source of making rubber? It's oil, so it's refined. They refine the materials, and now they got ways to make all their products. So
that's another reason why we invest in real estate too, right? Everybody needs a place to live, whether it's a house or an apartment. May not need the latest Amazon, Amazon, whatever they're selling me today, but everybody needs a place to live in America. And that really,
everybody needs a roof.
It's not something that AI is ever going to be able to fix.
So that's correct. And it's the way the reason I like real estate is because I can touch it.
Mm-hmm.
I can lease it. I can sell it. I can do multiple things with it, and I can repair it. I can improve the property and maybe raise the value, like many of the operators in the multifamily space do. It's value add when you guys go and invest a lot of money into it.
Yep.
But let's go back to the syndication operation, because I've syndicated before, and I was syndicating for I own a lot in Sweeney, Texas, where I was gonna build some boat and storage for boats and RVs.
Okay,
maybe that's something you and I can talk about off camera. And I went ahead and did a 506B, because I wasn't gonna go and run ads to it or anything like that, and it was pretty much friends and family. Um, and everything was ready to go, and I had $1 million on my hand. I was raising only 2 million, but the reason I was doing 2 million is because I was doing it cash. I was gonna build the whole thing cash, and then I was gonna go to a bank and refinance when the space was full. It only cost me about $2 million to build the 96 units that we had planned to build, which we still have the plans. I just haven't pulled the trigger, but I think I will pretty soon. Um, and I had $1 million, and
You had a
COVID
million
happened.
raised, or you had a million?
Yeah, I had already. This is back in 2020, and then COVID happens.
I was going to say, bad timing.
Man, it was now. If I had a crystal ball and I knew how COVID was going to, happen in the next few months, I would have kept the $1 million and raised the other million. But I was so scared to have people's monies on my hand with an unknown. This is the first time it happens in our lifetime. That the world shuts down.
Right.
I sent all that money back, and I only kept 2 investors on the deal. That the ones that I used for the land and some closing costs and things of that nature, and we still own it. But I did a 506B. What kind of syndications have you done for your multifamilies?
I've done both B's and C's. Yeah. So
And
I'm
which one is
agnostic.
your preferred method?
Well, I would prefer C. So that's five. So for your listening audience, there's a get around for guys like Ricardo and us to raise money to stay clear with the SEC. There's a couple exemptions that you can work with in their code regulations. 506B as in boy and 506C as in Charlie. B is you're limited to friends and family, and you only have to be sophisticated investors. C506C is you have to be accredited investors, and that means you have to have an income. I think it's $200,000 for the last 2 years, or have a $1 million net worth outside of your primary personal residence. So, I mean, the theory is that if you're going up to 506C, you got people that are much more savvy and they have more money. Quite honestly,
Right.
The advantage of the B is that you can take 25 or whatever you want from whoever and go after smaller sums of money. But both have their advantages and disadvantages. I like the C only because I'd rather have fewer investors. And the people that have assets are less likely, quite honestly, to be troublemakers and ask all kinds of questions every month or every week about what's going on in the property that you want to avoid. I want to be transparent with my investors, but I don't want to be bugged every week or every month about why water's up 20 cents or something.
Right. And that's true. That's completely true. It attracts a whole different type of audience, right? So
Yeah,
it's like the $50 client or the $500 client. I'm making this investment for $500. I hope it all pays well. Blah 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 blah. Right? And they give you all this trouble over $500, and then you got the $50,000 client that says wire sent,
and you
that's
never
it.
hear from them. And you never
hear from the guy, right? So I guess this is the first time I hear this, Randy. By the way, I kind of like that analogy in between 506B and 506C. Now on 506C, you can go and do advertising, and you can
correct
run ads to it. You cannot do this for 506B, by the way.
correct.
And by any means, we're giving any legal advice here, guys. You guys need to go consult with an attorney if you guys are planning on doing something along these lines. We can refer you to people. So uh, hit me up on the private message if you want to know who I personally use. I don't know who Randy works with, but I have my preferred attorneys that I consult everything through. And shout out to Tony Dixon and JJ Childers. So they are the ones that guide me in the right way. And you're free to look them up on Facebook, IG. They're all over the place. So they're great people. So now, Randy, let me ask you a few more questions about multifamily because I like our conversation. You're very knowledgeable about the subject, and I see why you're operating. You're operating more than 4,000 doors, correct?
Well, I primary as a general partner in about 1,000 doors, and then I invest in other people's deals. So yeah, I have another couple thousand as a passive investor. So I do both
Okay,
the passive and general partner.
perfect. So,
Totally
um, no, that's good. I mean, there are people out there listening to us that they're not operating one door, and that's where they want to get to their first door so they can go start scaling. I remember when I was first getting started, all I wanted to do was do one house. That was it. Like, how can I do one house? And 1,000 houses later, it's now it's like, I don't even know if I want to do one house. It's one of those things. But what makes, in your opinion, and I understand numbers is always going to be number one. Um, but aside from numbers, what is a good investment in multifamily? Like, what are the things that in Randy's playbook that you look for?
So we call that the buy box. What's my buy box?
Your buy
And,
box.
and so
Yes.
I would say, people ask me this all the time, and I say, so first and foremost is you want to buy in areas or regions of the U.S. that are growing in population and are growing in income. So pause and just think of that. So places growing in income and growing in population. Why is that? Well, the greater the population and the greater the income, the more likely is they need a place to live and they can pay more for it, quite simply. So I put my buy box as the Sun Belt from the Carolinas over to Arizona. I'll avoid the coast, the New Yorks and the Californias at all costs because they're tenant friendly states versus landlord friendly states. So one, it's high income, high growth, landlord tenant friendly. So states like Texas, Florida, the Carolinas are landlord friendly. We can kick a non-paying resident out within 30 days in Texas. I have a friend that does this in New York, and he says he's had people in this place for as much as 18 months before he could get them out for non-payment. And that's just, I just can't afford, any business owner can't afford to give away their product for 18 months.
It's crazy.
So I think the biggest one is population growth. And then the next one that we talked about before is find a sponsor, somebody that's done this, somebody that you know, like, and trust, somebody that you're going to feel comfortable giving $50,000 to. Even if you got it, you should be questioning them about their abilities to do so. But those are a couple ones off the top of my head. But so I say, people send me a deal. My first filter is, where's it at? Excuse me. So if somebody sends me a deal in Toledo, Ohio, and I'm from Ohio, no thanks. I don't care if I know the person. I don't care if it's got a 20% IRR. Somebody can invest in it. That's great if it fits their buy box, but it's not in my buy box. So that's a first filter. And then the second filter is who's presenting the deal to me. Is it Ricardo, who I've known for years, and he's done a great job for me over the years, or is this Ricardo's first time in the market? He's buying his first property, or is he partnering with people that have got more experience than him? What's their track record? So there's a lot of variables, but summarize all that in one: education. Investors need to educate themselves. This isn't like the stock market where you throw money in my 401k and I pick a growth fund versus an international fund. To me, that's called speculation. When I'm in my 401k, I'm speculating. I'm just throwing money at a large cap fund or an international fund. An investor is one who knows the business plan, understands the risk, and goes ahead. That's what you were doing in your deal in Sweeney.
Yeah, 100%.
You understanding the difficulties, the challenges in making this operational, building it, filling it up, blah, 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 and decides to go forth. That's an investor. A speculator, somebody just says, I'm just throwing money at Ricardo because I like him. He's a good guy.
Now, what's next for you, Randy?
What's next for me is I'm kind of in a holding period right now. So I said I own, and I'll continue to own, but I'm waiting for the market to stabilize a little bit. I'm hoping that I'm really trying to find a deal that is a distressed property that somebody needs to sell, because I think that differentiates it.
Yeah.
I've also gotten involved in a build to rent project, which is another classification of multifamily. Those are units that are just that. They're built to rent. They look more like a house. So these are townhomes in Melissa, Texas, where they've got a 2-car garage and a small patio, 2 bedrooms, 2 baths, and about 1,700 square foot. So they're bigger. So I'm trying to find something that's different, that not your traditional value add deals so many multifamily people talk about, where you're just buying a 1980s product and you're sticking lipstick on the pig and charging more money.
Right.
I'd really
Yeah,
like to move. I'd really like to
Yeah.
move away from the syndication business too. I'd like to find a property that I can just own for 30 years and cash flow it.
I like that model also, being 100% owner of mine things. Although sometimes you need help from other people because your money can only go so far, right? Like, unless you have very, very deep pockets. Um, it's I can spend as many millions of dollars as you have right now with no problems in buying real estate, So, it's but I met a friend in he's out of Virginia Beach, and his whole model is buying properties free and clear, basically,
Wow.
and growing his business like that, right? And he has a whole education system behind it, and he says, Ricardo, I never have to work on a day in my life because with less houses, I got more cash flow than some of these people have with millions of dollars in debt. And they're not even pretty houses. They're little boxes, that people live in, but they pay their rent, or he actually owner finances them to the people. So he explained to me his model, and I was like, huh. So I started kind of like applying that a couple of years ago, and it's not fast, it's not sexy, but man, once you got those houses free and clear, it's like
Cash cow.
it's a cash cow, because now the whole payment goes to you, but less taxes, of course. You're although they're talking about getting rid of property taxes in a couple of states. I hope that happens. They're gonna make those states very, very sexy for investors for the next few years. But because that's a big chunk that goes away here in Texas.
Oh man. Yeah.
Property taxes are huge. $1 million home here pays $38,000 a year. That's crazy.
And in Texas, for those listening outside of Texas, Texas reappraises every year. So your taxes can go up 20, down 20, up 30, down 10. I came from Ohio, where they only reappraised every 7 years. So big difference, right?
Wow.
Big difference. If your property's only getting, you can milk that cash flow for 7 years before you have to have it increased.
Wow. Well, Randy, thank you so much for being here today. I love this podcast, this conversation, and getting to know you a little bit better. Maybe we go grab a cup of coffee or something like along those lines in the near time. Guys, don't forget to hit share, like, and subscribe. The Real Estate Entrepreneurs Podcast. Randy, how can people get a hold of you?
Well, thanks again, Ricardo, for let me be here. It's been fun. Easiest way to get a hold of me is I'm on Facebook, LinkedIn. My corporate website is invest-arc, A-R-K, invest-arc.com. And there's a contact page on there for me. I'd love to chat with you and get to know you and help you any way I can.
With that being said, guys, we have a 10 growth coming up in November 7th, 8th, and 9th in Charlotte, North Carolina. 3 days, 2 days of English, 1 day in Spanish. I'm looking forward to see you there. We're going to have a bunch of great speakers, sponsors. It's going to be a beautiful event. And write down the dates. 10 growth, November 7th, 8th, and 9th. Send me up a message. You're going to start seeing ads pretty soon going up in near your hometown if you're in Charlotte or Raleigh. I'm looking forward to see you there. With that being said, Thank you so much, Randy. I appreciate your time and your knowledge and giving up a lot of value today. You were very valuable on all the answers you gave us. A lot to learn from you. With that being said, thank you so much.
Thanks, Ricardo. Have a great day.
My pleasure. You too.